In today's video, I'll delve into a disheartening Social Security update, shedding light on the dismal figures that underscore just how poorly we've been treated. Let's dive right in and dissect the details. A recent report on Social Security has once again revealed a bleak reality. In 2023, we were once more shortchanged by the system. The numbers I'm about to share might shock you, but they're all too familiar in the realm of Social Security's financial woes. First off, let's talk about the Social Security Trust Fund, which currently holds a staggering $2.8 trillion. That's a substantial sum, no doubt. However, it's crucial to understand that this money doesn't just sit idle. It's invested, albeit with limitations on where it can be placed. Last year, in 2023, the trust fund saw a measly return of 2.4% on that $2.8 trillion through its investments. To put it bluntly, that's abysmal. To put this into perspective, that 2.4% return amounted to a paltry $67 billion in interest for the Social Security Trust Fund. While $67 billion sounds like a lot, considering the massive $2.8 trillion investment, it's merely a drop in the ocean. For comparison, even a modest savings account today could yield a significantly higher return. Take, for example, a simple savings account offering a 4.5% interest rate. Such a rate would far surpass the returns Social Security is seeing. Now, let's talk about the outflow. Currently, the Social Security Administration disperses approximately $100 billion each month to beneficiaries. This hefty sum dwarfs the interest earned by the trust fund. In fact, the $67 billion earned in interest barely covers a fraction of a month's worth of benefits. But here's where things really start to sting. While Social Security's investments returned a meager 2.4%, the S&P 500, the benchmark stock market index, soared, delivering a whopping 26% return in 2023 alone. Imagine if Social Security could have invested in such assets. Hypothetically speaking, had the $2.8 trillion been allocated to stocks and earned a 26% return, the fund would have reaped around $700 billion in additional returns. That's enough to cover 7 months' worth of benefits for beneficiaries. To add insult to injury, the 2.4% return didn't even keep pace with inflation. In essence, while the trust fund received $67 billion in interest, inflation likely eroded a significant portion of those gains, possibly to the tune of tens of billions of dollars. The depletion of purchasing power within the Social Security Trust Fund by an estimated $100 to $120 billion, despite a $67 billion return, highlights a concerning trend. Inflation has eroded the fund's value, underscoring the flawed nature of the system. While some may advocate for investing the trust fund in the stock market, this approach carries significant risks. A major market crash could wipe out the entire fund, jeopardizing the stability of the program. It's crucial to recognize that safeguards were implemented in the Social Security program nearly 90 years ago to prevent such risks. These measures were intended to protect against reckless decision-making by lawmakers that could endanger the fund's stability. However, over the years, little has been done to address the fund's vulnerabilities, leading to continued losses. The current situation is particularly concerning because the trust fund is being depleted while Social Security payroll taxes continue to be collected. Despite this influx of revenue, the fund's value is diminishing due to poor investment decisions. One alternative approach would be to invest the fund in bonds, which typically offer safer returns. By diversifying the fund's investment portfolio, it could potentially generate higher returns while minimizing risks. For example, investing in bonds last year could have yielded returns of around 5–6%, effectively doubling the fund's earnings. By staying informed about these issues, we can advocate for better management of the Social Security Trust Fund and ensure the long-term stability of the program. Ignoring these challenges will only lead to further deterioration and potential benefit cuts in the future. It's essential to engage with these topics and push for responsible decision-making to protect the financial security of current and future beneficiaries.